What really happened to Silicon Valley Bank? Silicon Valley Bank, the 16th largest lender in the country with assets worth $200 billion, went bankrupt on March 10th. Since the global financial crisis, many of its deposits have been insured by federal insurance. Every American should have faith in their deposits' availability whenever required. It revealed some significant weaknesses in the banking system. Welcome back to Optimize. In today's video, we'll see what went wrong at Silicon Valley Bank and what will happen next. The largest U.S. bank failure since 2008 is now widely recognized as Silicon Valley Bank. SVB was well known in the tech community, which has a substantial presence in the San Francisco Bay Area, before becoming well known worldwide for its dramatic collapse. According to Matthew Faulkner, assistant professor at San Jose State University, the bank's failure has particularly impacted the area. Silicon Valley Bank was a label unfamiliar to people outside Silicon Valley and the tech industry. Venture capital companies, startups, and affluent tech professionals were among its many clients. SVB successfully competed against well-known financial organizations for about 40 years before it went out of business in a couple of days. As the largest U.S. bank to fail since the 2008 global financial crisis, Silicon Valley Bank, which catered to many of the most influential tech investors in the world, collapsed and was taken over by federal regulators. But regulators started to worry about the financial stability of the New York-based Signature Bank, partly due to its significant exposure to the volatile cryptocurrency industry. The FDIC, or Federal Deposit Insurance Corporation, now controls both banks. When depositors hurried to remove deposits totaling tens of billions of dollars late last week, it was practically a run on Silicon Valley Bank, according to regulators, who then announced the takeovers. Shockwaves from the crash have spread throughout the financial sector. The bond market has seen dramatic swings, shares of tiny regional lenders have taken a beating, and now there is pressure on the Federal Reserve to hold off on raising interest rates, even though inflation is still high. According to the bank's history from 2003, Bill Biggerstaff and Robert Medeiros came up with the idea for Silicon Valley Bank over a game of poker and launched it in 1983. The creators intended to offer banking services to Silicon Valley's tech businesses. The business started selling stock on the NASDAQ in 1987. It finished its IPO and raised $6 million in equity a year later. The bank gradually increased its area of operation in Silicon Valley before expanding to the East Coast in 1990 and opening a Massachusetts office. According to the bank's chronology, SVB established offices in Israel in 2008, the United Kingdom in 2012, and a joint venture in China in 2014. Throughout the past 10 years, other offices have opened in Europe and Canada. It even grew to take advantage of the tech industry's apparent fondness for California wine. According to Greg Becker, CEO of SVB at the time, and Rob McMillan, Executive Vice President of SVB at the time, speaking to The Street in 2015, the bank's wine business was a crucial component in developing the bank's image and connecting with Silicon Valley entrepreneurs. According to the website, the bank's $14.6 billion gross loan portfolio comprised 6% of SVB's wine business that year. Regulators estimate that SVB has $175 billion in deposits as of December 31, 2022, and $209 billion in assets. 44% of American venture-backed technology and healthcare IPOs, according to SVB's website at the time, bank with the company. Moving on, even though it was one of the top 20 banks in the nation, you didn't always think of it as a bank in the way you would think of a Wells Fargo or Chase, Faulkner claimed. The Janet L. Yellen Professor of Finance and Management at the Yale School of Management, Andrew Metrick, remarked that SVB was still seen as an establishment bank despite this. According to Metrick, these individuals have been in Silicon Valley for a long time and are significant institutions. The epidemic saw a growth in the number of tech businesses, which helped Silicon Valley Bank's operations. The bank's clients stuffed its coffers with over $100 billion in deposits. The SVB, which had plenty of cash, put billions of dollars into long-term U.S. Treasury bonds in 2021 when interest rates were at historic lows. These U.S. government-guaranteed bonds are typically regarded as low-risk, safe investments. But long-term bonds risk losing value if interest rates rise, if they aren't held until maturity, and only then do they pay out in full. And that's exactly what happened in 2022 when the Federal Reserve started aggressively raising interest rates to control the inflation that had gotten out of control. The value of government bonds, particularly those held by SVB, suffered due to this rate rise. Since they were long-term interest rates, the issue was that they were worth less than $1. They had to reduce the price to sell them, and it might have been prevented if managers had acknowledged that interest rates might increase. As long as SVB didn't need the money, this wasn't a problem. However, the tech industry has experienced a downturn recently, and businesses have progressively started to take their savings out of the bank. SVB claimed last week that to cover those withdrawals, it was forced to sell a portion of its bond assets at a significant $1.8 billion loss. The bank's customers were alarmed by that news and began withdrawing additional money due to their concerns about SVB's future survival. This is known as a bank run. Several banks that may have shared some of the same risks as SVB suffered a sharp decline in the value of their stocks on Monday. Even the established financial institutions have been affected. JP Morgan has been down more than 7% since last week, while Wells Fargo and Bank of America are down more than 15%. A California-based bank that serves the cryptocurrency sector, Silvergate, revealed plans to wind down operations earlier this week. Regulators took over New York-based Signature Bank on Sunday. It entered the cryptocurrency market in 2018 and saw $10 billion in withdrawals. Since last year, the value of cryptocurrencies has been impacted. According to analysts, the overall banking industry is still predicted to be strong in the long run. In a note published late last week, financial analysts at Morgan Stanley stated that SVB's problems are very idiosyncratic and should not be considered as a read across to other regional banks. They wrote, "We want to be absolutely clear here. We do not think the financial industry is suffering a liquidity shortage." According to Wells Fargo analyst Shaw, other banks were impacted by panic selling. "It's just a fear that has taken hold of the market, and at this point it's sort of self-perpetuating," he said. So what can be expected next? There will be the strict observation of the sale attempt process for SVP. Longer-term concerns about the health of banks will also come into focus, as investors are already doing. If interest rates remain stable, the Fed's borrowing facility may help with immediate liquidity needs. Still, it won't do anything to restore the value of the securities portfolios banks hold. In the years following the financial crisis, banks had disappeared from Washington's attention in many ways. All of that has since altered. So what do you think? Do share your thoughts in the comments section. Don't forget to subscribe to our channel for more interesting content, and we'll see you in our next video.